Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at IREN.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Let's do it.
The first thing we really need to address here is what I'd call a market identity crisis.
An identity crisis.
Yeah. The name IREN, it currently refers to two vastly different business models. And for you, the investor, you have to be really clear about which story you're actually following.
That's so true. It's like two different companies sharing a ticker. On one side, you have this regulated European utility, super steady, focused on cash flow.
The traditional play.
Exactly. And on the other, you have this high-growth, almost speculative North American digital infrastructure company that's just chasing the AI boom.
So let's start with that one, the one generating all the headlines, the AI infrastructure story.
Right, the exciting one.
This whole story is really defined by one thing, a massive, massive strategic pivot. The company went from being, primarily a Bitcoin miner.
Which is a volatile business to be in.
Very. And they've pretty much paused any more Bitcoin expansion. They're holding at around 52 EHs to pour everything into becoming an AI cloud services provider.
And the financial shift that came with that is just, it's stark. We're not talking about slow, gradual improvement.
No, not at all.
FY25 revenue hit $501 million. That's a 168% jump year over year.
Which is already huge.
But then, the real shocker was Q1 of FY26. Revenue came in at $240.3 million. That's up 355% year over year.
And look at the bottom line. That's where you see the leverage. The net income swung to a record $384.6 million in that quarter from a loss the year before.
Wow.
That's pure hypergrowth. It shows that, once they get this infrastructure built out, the profit margins are just explosive.
So this whole pivot isn't just a hope or a dream. It's actually anchored by some enormous multi-year contracts.
Oh, absolutely. This is the core of the thesis. We're talking about that reported $9.7 billion AI cloud contract with Microsoft.
$9.7 billion.
And a $5.8 billion deal with Dell for the NVIDIA chips they need to service it. Management is now targeting a $3.4 billion annualized revenue run rate by the end of 2026.
That is a giant leap. So what protects this business? In the AI space, everyone's fighting for a piece of the pie. What's the moat here?
They have two really key advantages. First, it goes back to their roots, power. They focus on ultra-low-cost, renewable hydroelectric power. They have 3 gigawatts of capacity secured, but they're only using about 16% of it. That's a huge runway.
So they can scale without having to find new power sources.
Exactly. And second, it's their tech. They use a proprietary direct-to-chip liquid cooling system.
Which is a huge deal for these new hot-running GPUs.
It's a massive efficiency boost. And in the energy-guzzling AI sector, that's everything. It's what allows for those high-end margins.
Right, you see it in the numbers. The gross margin was what, around 68% in FY25?
And if you just isolate that Microsoft deal, the projected EBITDA margin is something like 85%.
85%. That's incredible for tech infrastructure.
It is, and it explains why they're willing to take on so much risk.
Speaking of risk, that kind of growth, it demands capital. A lot of it. We saw that huge capital raise recently.
We did. It was around $3.6 to $4 billion in convertible notes and equity, and that was all designed to fund the GPU contracts.
So is the market okay with that? With the dilution and the spend?
Well, that is the primary risk. The market is absolutely in a prove-it phase right now.
I see.
The capital raise secured the funding, which is good, but the dilution was real. And when you commit to buying billions in GPUs, the execution risk is just sky high. If they fail to deliver on time,
then the stock could get hammered.
For sure. The pressure would be intense.
And we're seeing that volatility in the technicals, aren't we? After that just stunning 270, almost 300% rally, there was a sharp pullback.
There was. But what's interesting is that some analysts are seeing that correction as an accumulation phase.
So big money is buying the dip.
It looks like it. We're seeing signs of institutional accumulation, even though some sophisticated investors like Paul Tudor Jones took profits. The long-term bullish structure, above the 200-day moving average, that's still intact.
Okay, so that's the high-risk, high-reward AI story. Now let's do a full 180 and talk about the other iron.
Right. The integrated Italian utility. This is a completely different thesis. We're talking stability, regulated cash flows, and yield.
The defensive play. If you're looking to insulate your portfolio from, macro craziness.
Precisely. This company is one of Italy's largest utilities. It's all about regulated distribution networks and expanding their renewables, specifically biomass and waste to energy.
And their numbers reflect that stability. Q4 2024 revenue was up, 5.2% year over year, something around 979 million.
Modest, but predictable. And the key selling point here isn't growth, it's consistency.
Right. And cash flow.
They generated $412 million in free cash flow in FY 2024. That supports a pretty healthy 4.1% dividend yield with a safe 73% payout ratio.
And this is a business where I think 90% of revenue is regulated.
Which is the key. It provides a shield against volatility.
So their moat isn't tech, it's regulation and infrastructure.
It is. They have a sole regulated monopoly for electricity and gas in their main service area. They control 98% of the grid access there.
So you have to go through them.
You have to. Plus, their waste-to-energy contracts have inflation-adjusted fixed fees. So even when inflation rises, their cash flow is protected.
That's a strong position to be in. So for an investor looking at this slower, more predictable story, are there any near-term catalysts to watch?
There are, actually. The next big one is the Q1 2025 earnings release, which should be mid-May.
Okay.
And then, even more important, they have an investor day planned where they're going to outline their IREN 2027 plan for digitalization and renewables.
So we'll get a roadmap for future capital allocation.
Exactly. And there is one more speculative catalyst, the potential for non-repayable grants from the EU Green Deal. It's for a hydrogen pilot project in Genoa, and it could be worth up to $120 million.
Wow, so that's basically free money to cut their capital expenditure.
Essentially, yes. It could significantly de-risk that project.
Okay, so let's synthesize this for everyone listening.
Yeah.
We've laid out two completely separate options under one ticker.
Right. So for you, the listener, it comes down to a choice. Are you prioritizing the potential of the AI infrastructure play? The one with massive upside, but also really high execution risk?
Or are you looking for the traditional defensive utility, the dividend payer that's trading at a discount to its peers, backed by real, predictable free cash flow?
Yeah, the AI story is trading entirely on future earnings and execution. The utility story is trading on current stability and yield.
They're just two different animals.
Completely. And ultimately, your investment horizon and your own risk tolerance are what's going to determine which IREN story, if either, fits your portfolio.
And the good news is we don't have to wait long for the next major checkpoints for either of them.
That's right. For the utility, we have Q1 earnings and that big investor day coming up.
And for the AI player,
the focus is on their capital clarity update, which should be coming around February 2026. So keep a close eye on those inflection points. They will really define the path forward for both of these businesses.
that wraps up our analysis for today. Make sure you hit that subscribe button to catch our next stock analysis tomorrow.